mute everyone as well, right, Colleen?
Yeah.
Good morning, everyone. We'll get started in just a minute. Okay, I'm showing that it's 10:30, so we're going to get started. Anyone joining us can pick us up midway. Good morning, everyone. My name is Linda Hall. I'm the president of Connected Community. We are a nonprofit organization here in the northwest suburbs of Chicago, serving young adults with developmental disabilities and their families, with a focus on preparing for and navigating transition out of school and what life will look like in the community. This Transition Summit is just one part of our educational outreach initiative, which also includes monthly Friday forums and informational tours. We also provide social and volunteer opportunities for our young adults and customized employment services as well. There are a couple people who did register for continuing education units for these seminars. If you are one of those people, you were sent an email this morning with instructions on how that's going to work, so please check your inbox. We are keeping all the participants muted throughout the seminar today. If you have questions, please put them in the chat and we will try to get to as many as possible before the end of our time. We do have a hard stop at 11:45, which gives everyone a chance to have some lunch before the afternoon sessions. So if you have any questions about anything, please just stick it in the chat. So I want to welcome this morning Nancy Spain. Nancy Spain is the co-founder of Spain and Varnett, a law firm specializing in, among other things, special needs estate planning, government benefits, and guardianship issues. She's a charter member of the Academy of Special Needs Planners and regularly speaks on issues of guardianship and special needs trusts. I really appreciate her willingness to share her time and expertise with our group today. So please help me welcome Nancy Spain.
Hello, everyone. Thank you for being here on this lovely Saturday, taking time out to learn about how you can use what Sherry Snyder probably taught you this morning. I'm going to follow up on anticipating that you have some understanding of the government benefits and why it is that they are so important for you in planning and the transition, but also planning for the future for your children. So I'm going to speak more on the legal ways in which you can make sure your child continues to be eligible for benefits during your lifetime and after you are no longer able to take care of and manage the finances for your child. If you'd like to receive our newsletter, we send out a couple of newsletters monthly with updates, changes in the law, and things that might be of interest to you. If you'd like to, it's free. but you can email either of those two and get on that list. So this is what I'm going to be talking about. I'm going to be talking about the estate planning part to ensure that the other planning that you are going to be having to do with government agencies and school and other groups that may help you with planning for your child, how you can plan and make sure that those all fit together as you age and as you plan for your child's future. So we're going to talk about how those are implemented by using documents like wills, trusts, and other ways in which you can preserve assets and save them to provide for your child later. The reason that you are going through are going to be dealing with transition is because at age 18, you actually lose control over your child unless there is a guardianship, or your child may name you as agent under a power of attorney, but you need to come to the understanding about that independence at age 18. And there are things that the child can dictate and say with regard to their IEP and their health care, unless you are guardian or unless they allow you through a power of attorney. So in order to access government benefits, you have to have some ability to speak for them and help them. And so this is an important part of it as well. So as Sherry probably went over the government benefits, the different kinds, there are some that are related to a child's eligibility financially, and there are others that are related to your earnings and your Social Security and how your child can benefit from government benefits that you're eligible for. And then supplemental nutrition assistance, the SNAP program, and some other things are income-based and sliding scale, which are also affected by the assets that the child has. So the planning that I'm going to be talking about is a way in which you can make sure that your child is eligible for the government benefits that you see there. Okay, so the important thing about the age 18 is up until age 18, your child's eligibility for things is based on, at least in part, on your income and your assets. And so unless you yourself meet the eligibility economically, your child is not likely to be getting SSI at this point. There might be Medicaid eligibility, and in Illinois, there's expanded Medicaid. So your child might be getting some Medicaid benefits, but at age 18, the child becomes his or her own person and own independent economic group or family. And so you want to make sure that you keep your child in that position of being eligible based on the child's assets. So there are trusts are things that you use to be able to make sure that your child has the ability to have assets that are used for the child, but don't legally belong to the child. If they legally belong to the child, it's likely that the eligibility issues will be affected. So there are two types of special needs trusts. And the problem is people combine the names and often call either one or both by the words special needs trust. And essentially they act the same way in terms of making your child eligible and keeping and the way in which the expenses can be used generally, but the funding sources are different. So a third-party trust is one that is established and funded by persons, could be anyone other than the person with the disability. A first-party trust is, which also is called self-settled, it's called an Obra, and it's called a Payback Trust. This is done with assets that belong to the beneficiary, legally belong to the beneficiary. So for example, as I say here, it can be used for irrevocable assignment of a child support. The child support, when a child is 18, if there is a divorce in the family and child support is ordered in the divorce case, it must be irrevocably assigned to an Obra trust in order for it not to count as income. But it must be an Obra payback trust, even though it is the money coming from one of the parents. It is the right of the child to receive the money. So legally, it's the child's money, and legally it has to be placed and assigned to be paid to the Obra, and that has to be done by an order in the divorce court to irrevocably assign it there. The Obra trust can also be used for PI settlements, even if the settlement is paid directly by an insurance company or a defendant to a trust. It legally belongs to the child. The child technically has a legal right to take it in his or her own name, in which case the government believes that that should be in an Obra and not in a third-party trust. Oops means that if there is a situation where, for example, a grandparent or a parent dies without documents and a child inherits money, it's not intentional that this was a way in which the child becomes ineligible. But at that point, as long as the child is still disabled and under the age of 65, the fallback plan is to do a first-party trust. If grandma had planned properly, she could have left it in a third-party trust and there wouldn't be a payback, which I'm going to go back, discuss in a minute. So the third-party special needs trust allows for a discretionary trust and supplemental government benefits. Those are the reasons why you have a special needs trust. The difference is the third-party trust can have different ultimate beneficiaries. The first-party trust must be paid back to the government. So a third-party trust is something that a parent or grandparent or sibling sets up for a child or a person with a disability, and it can be and is often revocable until it's funded. So when you are setting up a document, your estate plan now, and you're not funding it until you die, the trust just remains as a vehicle that will receive it at some time. So it's ready and in place. But it's not funded and there's no tax returns. There's nothing really to do other than keep it up to date. Sometimes a second to die policy is used to fund it. It's a life insurance on both parents, and the second to die, the proceeds are payable to the special needs trust. The big difference between a third-party trust and a first-party trust is the last item on that list. There is no payback to the government, which I'll explain in a minute. Okay, so the first-party trust, in other words, this is money that belongs to the child legally, must be irrevocable. The beneficiary must be disabled and meet the definition of disability per the Social Security Administration, which I'll go over in a minute, although I'm sure Sherry discussed that this morning. The assets have to be held for the sole benefit of the person with a disability, and the beneficiary has to be under the age of 65 to set up the trust. The assets held for the sole benefit was stricter a few years ago. There was a lot of discussion about how strict that had to be, and if anyone else could benefit from anything that was spent in the trust, there was a suggestion that the trust was not valid. However, Social Security has loosened those, and so it is for the sole benefit, but if there is a peripheral benefit to family members or someone else, it's not going to make the trust invalid. Okay, so the first party trust might be court monitored if there's a guardianship involved. For example, if there was a PI settlement and money was received, most often in Illinois, the settlement has to be approved by the court, and the guardianship court would approve that settlement. And so being court monitored, it would be subject to a court-ordered budget. And so that there would be an order that the trustee would have to look to see what was allowed to be paid out of the trust. There are things that the first party trust cannot pay at the death of the individual. So one of the things that's very important is during the life of the child, where there's a special needs first party trust, that it should have a prepaid burial, because after the death of the individual, the trust cannot pay for the burial or a funeral for the person. But a prepaid burial or funeral plan is an exempt asset that the trust can hold. So prior to death, it's important that that be done if there is a first party trust. The big thing is the payback to the state. At the death of the individual, if the child has been getting Medicaid, and Medicaid paid for care and or a residential placement, then to the extent that there are funds in the trust has to pay Medicaid back for whatever Medicaid advanced. SSI and other benefits, SNAP benefits or Section 8, are not required to be paid back. There are pooled first-party trusts. If this trust is small, it can be pooled by a not-for-profit trustee that's connected to a bank, and they are pooled together for those investments. And it's a way, if there's not a natural family member who could be, or it's not sufficient of size to have a bank be the trustee of that Obra, then it can be in a pooled trust. It's same things held for the sole benefit, and there is still a payback to the state because it is a first party trust. I will get into how those trusts are created in a minute. This is just another part, though, that is available as an alternate to some planning, depending on the amount of money that is to be set aside. This also can be done and funded prior to the parents dying or family members dying. This could be used for, and the ABLE Act can be used for smaller gifts to a child from family members and or a child's earnings. This was passed in 2014. It took quite a while for the states to implement it. It is, I think it's available in all states, because some states that did not set up a plan of their own may access the ABLE accounts in other states. Some states have their ABLE account only available for their own in-state people, but Illinois is one of a consortium. It's called, if you look on the internet, it's savewithable.com. You'll get to the Illinois one. There are slight differences amongst the various state plans. It is something that had to be coordinated with the state banking and with the IRS. And so it's not totally governed by Social Security. In any case, it's something that is a very good option that I'll describe in a minute as to why it's a very exciting addition to what can be used for planning. If the SSI, if a person gets SSI, then eligibility is lost if the ABLE account gets over $100,000. However, because there's a limit in the amount that can be deposited every year, it would be a while before you can get to 100,000 in any case. If the account gets to be more than 400,000 for Illinois, then Medicaid is lost. So that it's the same. It's the same as the 529 for education cap for Illinois. And that's how they figured that 400,000. There are a couple of rules that are very strict. One is that there's only one account per person. So if you set up an account grandma can't do a separate account, or someone else can't do a separate account, even in another state. If they're, one would be considered ineligible and cause the person to have assets, however much is in that second ABLE account. Some of the other rules that govern the ABLE account, the disability has to onset prior to 26. So for all of your children who are still in school, clearly the disability onset prior to the age of 26. There is some discussion whether or not the legislation will be enacted. I don't know, that the disability age might be increased to 46. The thing about 26 is it does eliminate people who have an accident or have a late onset disabilities. Sometimes things don't come up until later in life. MS, for example, or some other mental health issues don't come up until after the age of 26, so that it would be obviously a great help to certain people with disabilities if they increase the age. The annual contribution limit is $15,000. This is again tied to the Internal Revenue Service annual gift limit. So this is the ABLE Act is actually 529A. That's the section in the Internal Revenue Code, and it is parallel in many ways to the 529 Plan for Education. Obviously, the difference is that this is limited to persons with disabilities. So the rules with this are mostly in the Internal Revenue Code. New for 2018 through 2026, that's the sunset year. This is the tax legislation that Trump put in 2018, but that provision sunsets in 2026. So some of the things that are a great benefit will stop unless the legislation continues the benefit. So the increase in the benefit is that if your child is working and earning, the child can add the amount of earning to the ABLE account in addition to the $15,000. So if the child, let's say, inherits $15,000 from grandma in a year, and the child has a job and earns $2,000, the child can, if that's the interest, to put the $2,000 into the ABLE as well. Contributions by people, aunts and uncles, or anyone to an ABLE account are not charitable, so they're not tax deductible to the person who gives it. The contribution rules, as I said, it's limited to the $15,000 per year, not per person per year total. So if someone gives 10 to the ABLE account, then only 5 more can be put in unless it's the earnings for the individual. It is not pre-tax, it is after-tax dollars. The growth inside the account is tax exempt, like a 529 plan. There are unpermitted distributions. That means that this, unlike a special needs trust, must be used specifically for things related to the disability. Now, a special needs trust can be used for entertainment or travel. The ABLE account cannot be used for those unless, for example, the travel is with a group that is specifically geared for people with disabilities, and then there are other protections and special things going on with that travel that are related to the disability. If funds are misused, for example, this is an account where the child, if capable, can have access to the funds. And if the child then took some money out, and because there can be a credit card related to it, for example, and used it for something that was not related to the disability, like took his friends to the movies or something, there would be a 10% penalty for the misuse. That is an IRS code section, and it is an income issue, so that the receipt or use of the money, let's say it's $100, it would be considered income to the beneficiary, and then there would be a 10% penalty. However, if $100 of income is added to the income of a person with a disability, it is likely not to cause any tax, and there may not be any major result from having that penalty. One of the other issues that was increased with that tax that was done in 2018 is the ability to roll over a 529. So for example, if you have set up a 529 plan for your child thinking it was going to be used for college, and you now know that it will not be used for college, then you can, up to $15,000 per year, roll over that 529 into an ABLE account. But that counts as part of the 15,000. So just remember that, first of all, it's the most you can roll over in a year is 15,000, and it also, then it would exclude any other contributions to the ABLE account. As I said, this allows independence. That you have to decide whether or not your child is capable of handling the ability to use the money. There are some ways in which you can limit the amount that they have access to, and other ways that you can be the administrator, and but it does provide independence if they are able to do that. So it's only related to the disability, but it's a rather broad definition of related to the disability. Improving health, independence, and quality of life, including housing. Here is where an ABLE account can be particularly helpful in terms of the benefits for a person with a disability. If your child is in a number of years is independent enough to live alone in an apartment where there's rent paid, as you may know from Sherry's discussion before, if anyone other than the individual himself pays for rent or food, the shelter or food, then the person's SSI is reduced by 1/3. So, for example, if a special needs trust pays the rent for your child to live in a nicer apartment, because SSI is only $791, it's hard to get a good apartment and pay for food within that budget. So if the special needs trust pays the rent, then the child automatically loses 1/3 of that SSI. However, if the special needs trust or you or someone else puts money into an ABLE account and the ABLE account pays the rent, the ABLE account paying the rent does not count as income to the beneficiary and will not cause a reduction of the SSI. So your child could continue to get the full amount of the SSI, and the rent could be paid by transitioning money through the ABLE account to pay the rent. So this really increases the options for a person if that's of benefit to be able to pay the rent. It's very important that you keep detailed records of those expenditures, because it could come up that you have to show what happened to them. And again, this is example of the housing, of the expenses. Housing, not ISM. I'm sure that Sherry went over what that is. And it can pay the rent without the 1/3 reduction. So in ISM is in-kind support and maintenance. And that is what the government believes, that it should not give you the full SSI if someone else is paying in-kind support and maintenance to you. These are expenses that otherwise it can be, the ABLE account can be used for, specialized transportation, employment for training for special jobs that you might have, assisted technology. And again, the ABLE account can pay funeral and burial expenses. there's a requirement in the federal rules that there must be a repayment to Medicaid, which is similar to the Obra account. However, Illinois has stated that it will not enforce this, and many other states have said that they will not enforce it either. However, it's not been tried in court to my knowledge, so it probably is best to understand that you do not want to overfund the ABLE account. If you have a special needs trust, it should be kept at an amount that makes sense to be used pretty much annually for the things that a person would need. I mean, it does grow without tax ramifications, which is unlike a special needs trust where income earned by the special needs trust can possibly be taxable, but the payback is in a part of the ABLE account that is not in a third-party special needs trust. So again, it's going to be the same payment back for the medical assistance costs. A couple things here. It does not put the child, it does not help the child keep from being taken advantage of. In other words, if the child has access to the funds, then someone could talk them into doing something that is, being fraudulent, getting money from the child that would be obviously not a qualified use of the money. Anyway, it has some questions about whether or not your child should have it. If you have one and you're the administrator and there's no access by the child, if you're concerned about those things, then it certainly can be used and you can be the administrator. One of the other important questions that has come up, can the child put child support in there? No, the child support is the right of the child and it must go into the Obra. All right, so how do we fit all of this together? The first thing that's very important is at age 18, your child would inherit money, and if they inherit more than $2,000 from you, your child would lose eligibility for SSI and Medicaid. If the child is under the age of 18, it's treated differently because the child is still gets deemed income from you. So at age 18, you need to make sure that you are not, because since we all have no idea when we might die, it could happen before your child is fully capable of understanding it or before you've done your plan. So it's important that you understand the need to plan before your child turns 18. Intestacy is the word used when there is no plan whatsoever. It means testate is someone who has a will. Intestate is someone who dies without a will. And if you die without a will in Illinois and you're married, your spouse and your children will share in your estate. And that's a statute, and the shares that each child would get are mandated by the state. And whether or not you want it to go to all of your children or outright to children is not a choice you have if you are intestate. So it's so important to have at least a will. Other things that get affected by this planning are life insurance, IRAs, and pensions. If you have a life insurance policy and you have it says to my spouse, if living, otherwise to my descendants, and one of your children has a disability, it would go outright to that child if your spouse is deceased. And that would be an oops. You could put it in an Obra, but you can plan by having your life insurance payable to your spouse if living, and then to your children. But with regard to my child, Susie, who has a disability, it goes to the Susie Jones Special Needs Trust. So you can direct the life insurance to the Special Needs Trust, which you will have had to have created already. The same is true with IRAs and pensions. And there are special rules with pensions Certain pensions can be paid to a third-party trust for a child, special needs trust. Some pensions require that they be paid to an Obra. The VA pension for survivors benefits very specifically requires a number of rules to follow, plus an Obra trust, not a third-party trust. IRAs have changed in the past year or two because of what is called the Secure Act. The Secure Act expanded the ways in which IRAs and retirement funds can be used to enhance the life of a child with a disability. The Secure Act limited the time frame for payout on IRAs for persons other than a special eligible group, and those include the spouse and disabled children. So a spouse and or a child with a disability and a special needs trust for a child with a disability can take IRA distributions over the lifetime of the child or of the spouse. So for example, if you pass away and your IRA is payable to the special needs trust for your child, and your child is 30 years old, the child will have 50 years to take that IRA. And depending on the size of the IRA, some people have particularly large IRAs. That's where they put most of their investment. And in the past, if you had to take it over 5 years, that's a lot of income to have to recognize each year. And it would be taxable income to the recipient each of those years. If you can stretch out those payments for the required distributions over the lifetime of the beneficiary, then the income tax hit is a lot easier. So IRAs now it is probably preferable to leave your IRA to the special needs child and a special needs trust for the child, rather than to children who don't have a disability, because the new rule is that your child cannot take an inherited IRA and continue and get rollover it to be paid out over their lifetime, which used to be the rule before the Secure Act. So children without a disability need to take the entire inherited IRA over 10 years. So it could be a lot of added income to their other income for those 10 years. So something to think about in terms of planning for things that are not estate plan documents. Okay, so in eligibility for your child with a disability, one of the options is disinheritance. Obviously, you can leave it to another child who's not disabled and tell the sibling to take care of his sister or brother. We call these morally obligated gifts. But there are a couple problems with those. First of all, it's not legally enforceable. If you give it to Johnny to take care of Susie, Johnny doesn't have to do that. And if you give it to Johnny in his name, it's not creditor proof. If Johnny gets a divorce, his spouse could sue him for the money. His creditors, if he has credit cards, could come after the money that he has, and even though it's you intended it to be for Susie. So it's not a safe thing or a foolproof thing excuse me, to do. Okay, so the least that you need is a will. You need to name an executor who would be someone who would monitor what goes on in the will during probate. If you have a will, it avoids a surety bond. If you die intestate and your estate, including your real estate, is over the value of $100,000, or if you have $100,000 real estate at all, you have to have probate. And if you don't have a will that waives the surety bond, then a surety bond is required for the period of time of the probate, which could be a year or two. And it's like an insurance policy to ensure that the executor doesn't run away with the money and not pay it to the person he's supposed to pay it to. With a will, you get to direct where your assets go. As I said, intestate, the state says it goes to your spouse and children. If you want it to go to be dispersed some other way or disparately between your children, either more or less to your special needs child, that can't happen unless you have a will that directs that. There can be a testamentary special needs trust in a will, which means that in the will, you set up the provisions for the trust, and the trust comes into being at probate when the will is determined to be valid, and then assets can be directed to it at the end of probate. That's a testamentary special needs trust. So the third party special needs trust that's standalone is a document that you would have prepared in addition to the will. It is a separate document and a separate entity that is set up, and you name trustees. And again, if it's not funded until your death, that's it's similar to the testamentary, but it is available as somewhere where other people can leave money, where you can name your life insurance, where you can name an IRA to be paid to. We highly recommend the third party special needs trust because you can amend it during your lifetime, and so if there are changes in the law, which there clearly have been in the past 20 or so years that we've been doing, actually since '93, doing these, that you want to be able to have that ability to make changes to it, and without having to go through decanting or court or some other way to do it. It's easier if it's allowable in the document itself to make those amendments. Okay, so having this special needs trust, the will can name the special needs trust as the beneficiary of Susie's share, so the child's share is protected and not counted as a resource, which is what makes a child ineligible. So other than a will, you can do what's called a revocable living trust, and you do a pour over will that goes with it. But the revocable living trust is a document that's, again, separate from the special needs trust, and it is either you each can, a spouse and a husband and wife can each have their own, or you can have a joint revocable living trust. It kind of works like joint tenancy. All the assets are of the both of you are in this trust, and you're both co-trustees when you are capable. In any case, it's revocable, meaning that you can revoke it or amend it at any time. And being that it's revocable, it's not treated as a tax entity. So anything that is in your trust is treated by the IRS as if it is in your name for tax purposes. If you have things in the special needs trust and it gets funded, it's not revocable, then there is a tax, it is a taxable entity. But during your lifetime, the IRS says if you can revoke it, we're going to treat it just like your money. But for state purposes and estate planning purposes, putting it in a revocable trust takes it out of your name alone because you are trustee for yourself. And so you don't own it at death in your own name, and so you avoid probate. If you have all of your assets, at least no more than 100,000 outside the trust, then it avoids formal probate. So the key to this is, once it's established, making sure that all the assets that are required to be put into it are actually transferred by title to the trust. So for example, if you have a house, you own a house or a condo, that has to be deeded. The deed has to change to be paid so that the title is in the trust. It can hold out-of-state property if you have a family compound or a piece of property out of state. That can be deeded to the trust, and you can avoid independent probate in another state. It can distribute to the special needs trust if that's what you direct it to do. Can be amended, and again, it has neutral tax consequences because it's treated as yours for tax purposes because it's revocable. Okay, so the standalone supplemental needs trust, this is the third-party trust, is, as I said, created now, stands alone, meaning that it isn't something that if grandma wants to name something for your child with a disability, she would name this standalone special needs trust and could avoid having the child inherit in his or her own name and causing ineligibility. And as I said, there's a testamentary one, which could be under the will, but it doesn't come into being and grandma can't name it. The important part about having a special needs trust is really not during your lifetime, when presumably it's not funded, naming the trustees. It's important that you have a trustee who knows public benefits, has time to do the job, and if there's going to be significant funds, either if it gets funded by your IRA or a life insurance policy, and it's going to have more than several $100,000s in it, it's pretty important that you have someone who knows investments and knows tax, or the ability to hire people to do these things appropriately. So you could have a family member be co-trustee with a professional, such as a bank or a trust company, and you can have trust protectors that would be someone who would monitor outside. If you have a family member, you could have a trust protector who would get copies of accountings every year, or other ways in which you can monitor and make sure that things are being handled the way you want. And this would be obviously for after you are no longer around and the trust is funded. The special needs trust, again, is different from the Obra because you get to choose the remainder. So for example, if you set up this trust for Susie during her lifetime, you can state that at Susie's death, if there's money left over, it goes to Susie's siblings, or if they're not alive, to Susie's nieces and nephews, or it could go to a charity, a charitable beneficiary. For example, if Susie's been in a facility, it could go to the facility where she lived for the last few years of her life. It could go to any other charity you would want, or it could go to your nieces and nephews or someone else. When the third-party supplemental needs trust becomes funded, it becomes a taxpayer. It's an independent entity that is a taxpayer and has to file tax returns annually. The minimum amount of income that requires a tax return is $600. So if it has $600 of dividends or interest, a tax return is required. There may not be tax due, depending on all the things that go on with it, because if distributions are made for the beneficiary, then the trust gets a deduction, and so there's not necessarily going to be tax due, but a trust tax return needs to be prepared. If money is earned in the trust and about $12,000, if it's taxable, if the $12,000 is taxable to the trust, then the income tax rate is in the high 30s, 37, 38%. So the tax rates are high. The key with a special needs trust is to use distributions to pay for things or services for the beneficiary, and then the income that would otherwise be taxable to the trust flows out to the beneficiary. So presumably Susie, who can't earn more than $12,000 a year anyway, if she is disabled and eligible for benefits, she must meet the requirement of disability. And so adding $10,000 or $12,000 of taxable income to her in the form of distributions for her vacation or her classes or whatever it is that the distributions are made for, counts as income to her. But if you added those to the 12,000, if she even was earning that, the tax rates are definitely lower. It's going to be 10 or 15% as opposed to the 37%. So if the IRA, if it's the beneficiary of an IRA, as in the Secure Act, it is important that you understand the IRA payments to the Special Needs Trust are going to count as income. And so it's important that if an IRA names the Special Needs Trust, that there is an understanding that distributions should be made annually in order to make to avoid the high income tax rates, that if money and income stays in the trust. Okay, in the third party trust, Special Needs Trust, you could, if it's appropriate, leave your home, or you could buy a new home for the child. So if many parents that anticipate that when they pass away, their child will continue to live in the home, the third party Special Needs Trust can own the home, and third party Special Needs Trust can pay all of the expenses of the home and manage it, and the child can continue to live there. Obviously, if the third party Special Needs Trust owns the home and pays taxes and insurance and the ownership costs, that is ISM as to the child, so that the point is, if they are on SSI, they would get their SSI reduced by a third. However, it is likely when mom and dad have passed away, if they have paid into the system, as Sherry probably told you this morning, and the parents paid into the system, the child can access the parents' record for disability and get childhood disability benefits, which are not cut when there's ISM, because it's not counted against them. So if the child gets, say, for example, $1,000 in childhood disability benefits, and the trust pays for the housing and the mortgage or the whatever expenses are related to that house, the child's going to continue to get the same amount of the childhood disability benefits based on the parent's record. There can be a way in which you set up the third party trust so that if it owns the home, it could coordinate with a provider, for example, Trinity or Misericordia or some of the other agencies that have CILAs or have group homes, and have multiple residents who stay in the same home, assuming it's makes sense if it's a home and not an apartment, and they contribute to the cost. In other words, if they have a state benefit, some sort of stipend from the state for their residential placement through the state, that would go and help pay for the cost to maintain the home. It's a way in which you can have the child remain in a home with fewer people rather than being in a larger CILA or a larger group home. And so you coordinate with those service providers who have oversight depending on how much is needed for the children. For example, they come in and make sure everything's clean, make sure there's food, check medications, or there can be 24-hour care if the child and other residents who are there need to have that level of supervision. And again, remainder beneficiary options, it can be that the house remains in the trust And at the death of the individual, it gets donated, for example, to the agency, the service provider, and other children can continue to live there. That's obviously a choice that you have, or it could be determined that it be sold and the remainder beneficiary is your child's siblings or nieces and nephews, and that way. We have a book about home ownership and home control. If you'd like that, email us and we can send you a copy of that kind of planning that you can do. There's been all kinds of variations on that plan of who owns the home and how much each party contributes. Maybe it's a totally separate trust that all it owns is the home, and there are liability issues that maybe you want to do that and have just the home in a totally separate third-party special needs trust. Anyway, there are lots of options with that. We talked about intestacy, that if they inherit more than $2,000, they're going to lose their benefits. So if that happens by mistake, for example, the safety net is this Obra 93 trust, and underneath that is what Obra stands for, Omnibus Budget Reconciliation Act of 1993. It was a tax act that in 1993 made it harder for most people to become Medicaid eligible, but carved out this special trust that could be set up so that if a person with a disability had funds, the funds could be protected during their lifetime and not count against them for Medicaid eligibility. And the caveat, of course, is that they're the payback to Medicaid at the death of the individual. And as I said earlier, there are other names for this: first-party self-settled payback, but that's a specific kind of first-party trust that is the child's money or the child's legal right to the money. Okay, so if the child has assets in his or her name now, what does that mean as far as planning? If you have a UGMA or Series E bonds that were started when the child was young, those are things that when the child turns 18, they will start counting against them. Actually, a UGMA or UTMA, either one, those are Uniform Gifts to Minors Acts or Uniform Transfer to Minors Acts. And those are accounts where there's a custodian and the funds are held aside until the person is, in Illinois, is 21. And the UGMA and UTMA don't count against the child until 21, which is when the child would have access and be able to use the money. But it can't be just gifted away, or if the child has assets and you gave them away at age 17, there's going to be a look back and the government is going to ask what happened to those assets. So if there are UGMA accounts now or Series E bonds, there are ways in which those can be expended for the benefit of the child, and that is a legal use of the assets. UGMA and Series E can be cashed out and put in an ABLE account, and that's a possibility. So the thing is to make sure that at age 18, the child doesn't have excess of those assets. If there are a couple $100s of Series E bonds, it's just important to understand that those count towards the $2,000. Okay, so does the child have a legal right to the funds? Those are the ways in which you determine whether or not it has to be in an Obra. These are ways that the inheritance came through. Sorry. If it's a direct gift, in other words, if a family member names your child specifically or says the descendants of my daughter, and one of your children is a descendant of that daughter of you, that is going to be a direct inheritance, and it will not be, it has to name the trust specifically to avoid being required to be put into an Obra. Okay, so the Obra does have some rules about what cannot be paid to the Obra. SSI, in other words, if your child gets SSI monthly, you can't turn around right away and put that in the Obra. The same is true with SSDI, which is Social Security disability or childhood disability benefits. That's CDB if your child is, I don't know if Sherry used the term DAC, which is a disabled adult child, DAC, is entitled to CDB. Those can't be put in. Certain pensions cannot be put into an Obra, as I said, and child support can't be put into an Obra without a court order. Now, if your child has SSI and you don't end up spending all of it at the end of the month and you're worried about that account getting over $2,000, if you leave it in the account, it becomes a resource. And I assume Sherry might have talked about this. SSI, SSDI, any of those in the month of receipt are considered income to the child. If that particular SSI payment has gone by the first of the following month, it becomes a resource. So if you don't spend all of the SSI for several months and you have excess in the account, the money that has been there longer than 30 days can be transferred to the Obra. But it's pretty important that you don't just immediately put money received, and you certainly can't cash checks or deposit checks immediately into an Obra account. Okay, so this is as I talked about, the special needs trust that's an Obra has to hold individuals' money. There's a payback to Medicaid before any other creditor or beneficiary, and it cannot pay the funeral or burial if Medicaid is not paid in full. If there's enough in the Obra trust to pay Medicaid in full, then there can be named beneficiaries who get the money, which could pay for the funeral. It could then be paid out to whomever is named in the document. There's requirements for the strict language that it's sole benefit. It does mean that you can't pay for everybody on a trip to go to Disney World. It can pay for the individual child with a disability and one caregiver, because clearly the child can't travel alone, or the adult can't travel alone. But it can't pay for everybody to go on that vacation. An Obra trust is treated as a grantor trust, and by that I mean it's a flow through. So similar to the revocable trust that you would create for yourself, although the Obra trust is not revocable, it must be irrevocable. The IRS says this money belonged to Susie, and we're going to treat it as Susie's money. So although the Obra trust has to file a tax return, it doesn't get taxed to the trust. It flows through and is on the tax return for the beneficiary. That's what a grantor trust is. It flows through and is treated as if it's the money that belongs to the individual. Okay, so there are rules to establish this about who can do it. Parents, grandparents, and now most recently, the individual himself may create the Obra trust. There are rules governing the provisions. It's pretty specific. You have to limit the distributions to things that are for the benefit of the person. And if they're too broad, it can't include things, as I said, like the funeral. Okay. I talked about this. Irrevocable assignment has to be by a court order. Another option for parents is the pay on death account, POD. earlier on, I talked about how if if the child gets SSI and does not pay rent or pay support and maintenance out of their own SSI, they get it reduced. But say your child lives in your home and gets SSI, but you want to make sure that they get the full amount. Your child can then pay a portion of the cost of the house, the income, a rent amount to you, although we don't really count it rent. It's their fair share of their household costs. And if as a parent you feel bad taking rent from your child, you can open up an account that would be in your name and have your tax ID number, so it's taxable to you during your lifetime, but it says pay on death on that account, so that when you die, those funds go directly payable to a third party special needs trust. So essentially you've laundered the money, in a good way. You have taken the SSI money that would otherwise get reduced and put it in an account in your name, because it's you pay for the house. So this is your child's share payment to the house. And you take that and put it in an account. It's your money now. You could use it during your lifetime for needs for the child if you wanted to. And what's there at your death would get paid to the third party trust. So you still need to set up that special needs trust to take the money when you die, but it's a way of not taking rent from your child with a disability, especially if that is bothersome to you. So, okay, so these are things that you need to think about. Think about the oopses I talked about. Not having a will, not planning ahead, not thinking about who are the beneficiaries on your life insurance policy, your IRAs, or other assets that have a named beneficiary. Teachers' pensions, if you're a teacher, there's specific language that has to go into your special needs trust to qualify that trust as a way of receiving the disabled child's portion of your teacher pension. So it's important that it can't be just a throw together a special needs trust. There's special language to make sure it's eligible for that pension. Think about the things of what there are for your child that need to count. Assets and deeming. How do you figure out that $2,000? Well, it's anything that's in the child's name. So if they have a little account where they earn money and they put it in there, and you have a SSI account where you put money into the SSI account, and they have a couple $100s of Series E bonds, all of those are going to count. The other thing that might come up is if you buy a life insurance policy on your child's life when they're little, sometimes those are, they used to be called penny policies when they were actually a penny. And you pay monthly or weekly the premium on a policy that was $1,000 or $2,000 or $5,000, and it was really for parents to have a policy that could bury the child if the child died young. Most of those policies that are purchased on young children have boilerplate that at age 18 or age 21, the policy reverts ownership to the child. So it's important that you look at those policies and confirm whether or not that happens. If your child gets it at 21 and the face value is $4,000, that's going to be a resource. So there are ways around that to avoid, if you paid all the premiums, you can get the insurance company to retitle and confirm that it's in your name. But it's important to understand that that's an issue. One other thing that's very important is a letter of direction or a letter of intent. This is a document that you create. I have a template, and you can email me if you would like, and I can send you a Word document that you can delete and add and whatever you want to do to it, a letter of direction. This is something you as parents know all the things that are important to your child, what the child's afraid of, what the medication is, who the doctors are, who the family members are. These are things that if something happened to you, um, who would know these things? And so this is a letter that you create that outlines all of those important things that someone who would have to take over for you needs to know, like right away, without experiencing that they're deathly afraid of spiders, or something else that, or at school there's a bully and you need to make sure that he's not in the same classroom or whatever. So this is something that you should probably consider looking at once a year, maybe on their birthday. You update it, make sure that the doctors are accurate, that they're even things like clothing sizes and things like that could be important. So it's an important document. And again, my template has a lot of those options, and you, as I said, if they don't apply to your child, then you can just delete that section. These are two planning guides that I think are just great. If you need something planning for the future, the special needs planning guide is starting at a very young age and all the things you need to do at various ages all along. And then there are some pitfalls, which I think we talked about, most of these anyway. Waiting too long to start the planning, that's important. We don't know when we can die, and if you die without a will, your child is going to inherit. And even if your child is under the age of 18 and inherits, at age 18, you're going to have to figure out what to do with that asset that they have inherited. So I don't know, I think I should stop. It's kind of getting time for questions. These are things you can kind of see. Oh, don't use documents from the internet, please. They, first of all, are not geared to the state of Illinois, and they often have things that are just not appropriate and terrible. So
thank you so much, Nancy. We do have a couple of questions, so I'm going to
Okay.
start with the first one we received was, can a person's SSI be put into their ABLE account?
The SSI after the first month of receipt can be put into an ABLE account, yes.
Okay. All right. Next question. Is a 401k plan handled the same way as an IRA? We were told by our financial advisor not to leave our 401k money to our children's special needs trust.
Generally, the 401k gets morphed into an IRA at some point. When the person leaves the job, it very often is no longer in the 401k plan. But the 401ks are treated like IRAs in terms of the payout and whatever. Although, if a plan is an ERISA plan, which is like government agencies and things like that are employers, often have ERISA plans, they might be treated differently. But generally, there isn't the same rule as before to avoid the special needs trust. It certainly is no worse than if you did it with your children, because at the worst, it's going to be the 10 years. So, I mean, if you give it to your other children, the payout for other children is 10 years. So it could be at least 10 years if that's appropriate. So I'm not sure that answers the question, and I think 401k may be different. Some of them may be a little bit different.
Okay. Thank you.
I'd say ask recently, because ask the person if the Secure Act, when did they get this information? Did they get this information in the last year or so? If not, then it's old information.
Okay. All right. And can they follow up with you to ask the question more specifically via email with those details?
On the 401k?
Yes.
It would really depend on their 401k. I mean, I think they need to talk to the provider and ask, when did they get that information? because
Oh.
it might be old information.
Got it. Okay, moving on to the next question. Can you move money from Obra account to an Able account? And if so, is it beneficial?
You can, and the question would be, assuming the Obra trust allows it. We have been adding specific language allowing the trustee to do that. I think that a trustee could do it under general language, but some people have said that they think that that could be an issue. So to the extent that you have an Obra and are drafting one, I would include language that specifically gives the trustee the authority to do that.
Okay, thank you. The next question, do you need to set up an Obra in advance in case a child inherits accidentally, or can you wait until that happens?
You can wait until that happens. I wouldn't do it otherwise unless you absolutely know it's going to happen. Like mom's will says that, and mom has dementia and can't change it. I mean, you know it's going to happen. But
Okay.
it's probably no harm to wait until it's actually needed.
Okay, thank you. Next question. I am a disabilities person. What is the best way for me to use the Able account? Including also my Able account card expires January of 2022. So what should I do with my card until then? I don't know.
So you are a person with disability and you have an Able account and you're wondering what to do. I would think that that you would go to the Able, I don't know for sure though. I would go to the Able website and renew a card. I think it's just like a credit card. You can get a credit card with your Able account, and I would think you just renew it. I don't know that. That's just a guess.
Okay, thank you. Request for a brief explanation for getting guardianship.
Oh, I was told not to deal with guardianships.
Okay, that's all right.
I mean, I can send a handout. If somebody emails me, I can send handouts on guardianship. Obviously, their standard is the person has to need a guardian versus just, a power of attorney can sometimes be appropriate. So I can't, I mean, that's a long question.
Okay.
I don't.
The next question is, and I'm not sure if you can answer this one either, generally speaking, what is the best plan to set up for your disabled child?
A plan, at least. I mean, the thing is, my thought is to have a separate standalone special needs trust third party because you have more ability to modify it and change it without changing your will. And then you have to just have a pour over will that pours over your assets. And at a minimum, that will, assuming you fund your trust and you don't have any of the other assets dangling out there like an IRA or a life insurance, you're going to probably be okay.
Okay. Next question. If I'm receiving VA compensation and pension, does this complicate my son's SSDI?
It might, depending on what kind of VA dollars you're getting. And if you have chosen for the survivor benefit, the survivor benefit does have to be in an Obra. So I can't really answer that without knowing the kinds of benefits you get. Some of them don't pass on, but a survivor benefit does, and it does require an Obra versus a third party.
Okay. And the next question, we have just two more. We're going to take these as quickly as possible. What should I do? I am 26 and disabled, but I don't want guardianship. And I want to live free and be in charge of my own money without government sticking their hands in my life. And they have enough money as it is.
Okay. you sound competent enough that you don't need a guardian. I mean, guardianship is for people who really can't make any decisions appropriately on their own. I recommend that any person over the age of 18, brilliant geniuses need a power of attorney, because you don't know when you're going to get hit by a car and need to have someone help make medical decisions for you.
Mhm.
So, I mean, every adult should have a power of attorney at least, and a power of attorney for property for the same reason. I mean, if you don't, and you just have to, you choose someone who would make and help you make decisions if you can't. And a power of attorney for healthcare, you make all of your decisions if you understand what the doctor's talking about, and the doctor says, do you want this operation? And you don't, you just say no, and you are the boss. The key is, if you're in a coma because you've just been hit by a car and for 2 days you can't talk, well, it'd be helpful if you had someone who could help make decisions for you in the meantime. The same is true with your finances. The person, if you're not competent and a doctor says you're not competent, then the person can pay your bills and do things. So, I mean, anybody needs those. I would recommend that even 26 and not disabled. Otherwise, though, if you have sufficient funds to pay privately for everything you do, and you have health insurance that covers what you need, then it's true, you do not need to be under the strict rules of the government benefits planning that I'm talking about. The key here, though, is for parents who don't know what's going to happen after they pass away and their child is totally incapable of living alone, it's pretty important that they have Medicaid eligibility, at least as a possibility at that point, because they can live independently in a SILA, and Medicaid at least pays for the residential portion of that, because otherwise it can be exceptionally expensive. And you can go through millions of dollars in a few years otherwise. And so, but if you know you're not ever going to need residential care, and you have Medicare, for example, if you are working and paying into the system and you build up your own Medicare eligibility, then you're probably fine.
Okay, great.
Okay.
Thank you so much. Yeah, that was excellent. Thank you. Last question. What types of expenses can you use the Obra funds? I guess
The
with
Obra can be used for a very broad things. If the person is on SSI and doesn't have an able to figure out how to get around the ISM, the in-kind support and maintenance, then the Obra should not pay for housing and food. The Obra can pay for, as I said, vacations and books, club memberships, entertainment. It can pay for, I mean, technically an Obra can own a house, but again, if the person's on SSI, the SSI gets reduced. If the person's on SSDI, perfectly fine. The Obra can own the house, let the person live there. So for a lot of the cases where we've had a personal injury settlement and there's lots of money, the child's Obra owns the house that he lives in, and mom and dad live there and take care of him. And when he ages out, if he gets SSDI based on the parent, or childhood disability benefits based on the parent, he's not going to get a reduced SSI. So, and it can pay for, I mean, it really is a broad, if you email me, I can send you a list, but I mean, depending on their ability, it can pay for sporting events to go to, sporting events to be in, as I said, vacations or travel or additional therapies that are not covered by their insurance. So it's a very broad thing, as long as it's for them.
Okay, great. Thank you so much. we've just gone over a little bit, but Nancy, this was excellent. So much great information. Really appreciate it. And Linda, will we start back up at
Thirty.
okay?
Everybody have some lunch and we'll see you at 12:30. Nancy, thank you so much for your time today. We really appreciate it.
Okay, great. Everybody enjoy the day.
Thanks so much.